focuses on an analysis report titled NBIS Stock, Why This Drop is a Golden Opportunity. Rocket.
It's a very high-energy, contrarian take on the recent drop in NBIS Group's stock.
Right.
The goal here is to make sure the analysis is as robust and as actionable as possible for a sophisticated investor.
Okay, so let's jump right in. To really maximize the power of this contrarian argument, the analysis has to explicitly address the negative catalyst.
The one that caused that huge 45% drop from the highs?
Exactly.
So we're starting with completeness and focus. You know, any great contrarian thesis has to conquer the reader's skepticism right out of the gate.
In this analysis, it does a good job framing the drop as a gift or a shakeout.
Sure.
But it never really gets to the why. Why did the stock fall so far to begin with?
That's the logical gap, isn't it? It's a huge one. You have these incredibly strong bullish points.
The 355% revenue growth, the $2 billion in cash.
All of it. But they're presented in total isolation from the bearish concerns that, actually drove that big sell-off.
An informed investor knows the market doesn't just slice 45% off a stock for no reason. There's a fear there.
Whether it's real or just perceived. And by not naming that fear, the analysis feels, it feels incomplete. It leaves that door open for doubt.
I see the challenge. So we're really asking for risk management to be woven directly into the bull thesis itself.
Yes. The analysis needs to show it's looked at the headwinds and found them manageable.
So the weakness is treating that 45% drop as just irrelevant noise.
Exactly. So the suggestion for improvement is to integrate a short but really powerful risk versus reward section right up front.
It doesn't have to be long.
Not at all.
But it has to explicitly name the likely bearish arguments. Maybe it's valuation concerns or fears about competition.
And then you immediately rebut them with the data that's already in the report.
Right. It's a subtle but really critical structural shift.
Because if you just list the facts, you're asserting strength. But if you name the counter-argument first and then use the facts to knock it down,
you establish dominance over the negative narrative.
But would adding a risk section sort of detract from that high-energy golden opportunity tone?
Not if you do it efficiently. So instead of just saying the story hasn't changed, the analysis should actively ask a question.
Like,
what's the specific risk sellers are focused on? Are they worried the 355% growth is unsustainable?
Okay, and then you pivot right to the rebuttal, which brings us to the most powerful tool already in the report. The concrete example here is just staring us in the face.
The $2 billion in cash?
Use the fact that NBIS is sitting on $2 billion in cash specifically to buy NVIDIA GPUs. That's the direct answer to any concern about execution or capital.
It proves the company has secured the resources it needs to keep going.
Regardless of temporary market anxiety, it's already been handled.
So the flow becomes, state the bearish fear, like execution risk.
Then the immediate data rebuttal, they have $2 billion secure to execute.
And then the bullish conclusion, which is that the risk is already contained.
Exactly. It flips that scary 45% drop from a historical problem into a current opportunity. It turns that $2 billion from just a static number on a balance sheet into a strategic weapon.
And that establishes immediate credibility with a skeptical investor.
Perfect.
That whole idea of shoring up the argument, it ties directly into our next point. This is about audience alignment and purpose fulfillment.
Right.
When you use that kind of high-octane language, you absolutely need the analytical depth to back it up.
I agree completely. The energy is great, the tone is urgent. It definitely grabs your attention.
But when you use phrases like screaming buy, or you call NBIS the next NVIDIA.
Those are big claims.
Huge claims. And they need more than just a declaration. They need some deeper comparative context.
So the weakness is this reliance on these impressive but raw numbers. The 355% growth, 100% upside. Without context, what do they really mean?
It's easy to say 355% growth. But if the entire sector is growing at 300% from a low base, that number suddenly loses its edge.
And the claim about building the plumbing for the AI revolution, that's a massive industry-defining statement.
And it's never really supported with comparative data.
That comparison to NVIDIA is the one. That's the core thesis that needs the support. Is there a risk that a $19 billion market cap company is being looked at without considering its valuation?
It's not a microcap anymore. This is institutional territory now.
And they demand proof. They need to see that this company can realistically follow that kind of historical path.
So the suggestion for improvement has to be using the known facts to build a better anchor, either a competitive one or a historical one.
You have to ground the hyperbole in history.
Exactly. If the goal is to justify those aggressive $150, $160 price targets, then the current growth has to be framed against some kind of industry benchmark.
So a concrete example, take that phenomenal 355% revenue growth.
Okay.
And frame it against the growth of another major tech leader when it was at a similar valuation stage. The analysis needs to answer the question, when company X hit a $20 billion market cap, what did its growth look like?
That's so much more effective. You're basically giving the reader a template to visualize the path to 150.
Or you could anchor it on the investment side to prove out that building the plumbing claim.
How so?
Quantify the scale of that investment. Show how quickly that $2 billion for GPUs is being deployed compared to the capex of its immediate competitors.
Ooh, that's good.
If NBIS is deploying capital at, say, 3 times the speed of its closest rival, that suddenly transforms the plumbing claim from just marketing enthusiasm
Into a quantified defense of its market position.
right. That detail tells the serious investor not just that they're growing fast, but how their spending power is creating a moat.
It moves the argument from, trust me, they're the next NVIDIA, to, here is the data that mirrors the early days of other tech giants.
And that directly supports the whole point of the analysis report, to show the opportunity is real, not just emotional hype.
Let's shift gears a little to the market mechanics and the technicals. Looking at this through the lens of angle and originality.
The technical section.
Yeah, it identifies that key $75 level, but I feel it relies a bit too much on a subjective narrative.
I see that too. It correctly calls $75 a massive psychological defense line. And it claims smart money is accumulating during this shakeout.
Which sounds great.
But the weakness is that the evidence is purely anecdotal. It's just that the stock stabilized in the afternoon and saw a little buying after hours.
And without specific volume data or something deeper, that claim that sellers are exhausted, it just lacks measurable evidence.
A sophisticated investor needs proof that this smart money idea is based on something structural, not just a convenient story. We need a real anchor.
I see the problem. A psychological line is, well, it's flimsy. It can break easily if it's not backed by something structural, something mathematical.
Right. So the suggestion here is to tie that afternoon price action directly to measurable institutional-grade evidence.
We need to redefine why $75 matters.
And link the activity to hard volume metrics.
Okay, so how do we upgrade that? How do we move this from a subjective observation to a thesis that an institutional trader would actually respect?
There are 2 really actionable, concrete examples here. First, analyze the volume profile.
During the afternoon stabilization.
Compare it to the morning sell-off. The analysis could point out that volume fell off a cliff during the afternoon session, right at that $75 level.
A sharp drop in volume at a support level?
It means supply has dried up. The sellers have run out of steam. That's the textbook definition of a classic shakeout.
That's so much more powerful. You're replacing the vague term smart money with objective evidence of institutional order flow. It gives the bear case a measurable point of failure.
And the second option, which gives you an even stronger anchor, is to research if that $75 level corresponds to a precise technical point.
Like a high-volume node from past trading?
A high-volume node, or even more powerfully, a long-term Fibonacci retracement point.
Wait, okay, so if you tie the $75 level specifically to, say, the 61.8% Fibonacci retracement from the last major low, how does that change the credibility versus just calling it psychological?
It changes everything. Psychological levels are arbitrary. Mathematical levels based on price history are structural.
Because algorithms are keyed to those levels?
Exactly. Institutional algorithms are very likely programmed to defend a level like that. So it provides concrete, quantifiable evidence. It transforms a subjective claim into a data-driven trading thesis.
That kind of depth would just significantly elevate the whole report.
And if you present that technical anchor first, if you start by saying, this 61.8% fib level at $75 is holding firm, then your claim about the afternoon shakeout becomes so much more credible.
The evidence supports the narrative, not the other way around.
And now you have a synergistic thesis. You have the fundamentals we talked about supporting the price.
And then the structural technicals validating the timing of the entry.
That's how you complete a really robust contrarian analysis.
This has been an incredibly useful breakdown.